Chapter 4 is one of the easier chapters that we're going to deal with in the book. Super easy. It probably is not going to be more than like 30, 45 minutes worth of work all total. Chapter 4 is really about closing the month and booking the adjusting entries. We're going to find out through the course or this chapter, we're going to focus on two primary types of account. We're going to focus on real or nominal accounts. Those are income statement accounts. So, for example, they're going to be your expenses and your revenues. It's going to be your dividend. And we're going to close those out, and we'll talk about how we do that shortly. But we're also going to go back through and focus on real accounts. Real accounts are balance sheet accounts. And these balance sheet accounts, basically, you don't do anything with. They carry from period to period to period. So you don't really have to do much with real accounts. But when it comes down to it, at the end of each month, on 30th, 31st of each month, depending upon what type of calendar you're on. Sorry. Anyway, so real nominal accounts. So temporary accounts, what we're going to end up having is that we're going to close those out. For example, we said before that 99% of the time we're going to go through and we're going to credit revenue. And that is we'll do that 99% of the time. When we close the month out, this one time, once a month, 12 times a year, that is the only time we're going to debit revenue. And in a similar fashion, we said that 99% of the time you're going to debit your expenses. At the end of the month, that is that 1% of the time that you're going to credit your expenses. That's how it's going to be. So, for example, what we're going to find is that traditionally, what's going to happen with our nominal and temporary accounts, what we're going to do is we're going to take whatever balance it is setting in those accounts, and we're going to do the exact opposite. So, for example, let's throw out a number. Pretend I have a $100,000 setting in revenue. So at the end of the month, when I start doing these adjusting entries, what I'm going to do is I'm going to debit revenue for $100,000 in this case, and I'm going to then credit income summary. You will always book that same entry. Always and forever, it's going to be the same entry when you close it out. Then on the flip side, let's talk about expenses. You'll have traditionally it'll be your normal entry will be a debit to expense in some form. So this is the one time, once a month, 12 times a year, you're going to debit your income summary and you're going to credit your utility expense. You're going to credit your salary expense. You're going to credit your rent expense. Basically, you're going to be crediting your expenses and debiting income summary. It will always be that same entry. It will not change. It will always be the same. Now, what's going to happen, though, depending if you have a profit or loss, when you transfer that final balance from income summary over, if you have a profit, you're going to book one entry. If you have a loss, you'll book another. So, for example, if you have a balance inside of So, for example, what we're going to do is, depending if you have a debit or credit balance inside of the income summary, that's really going to determine if you have a profit or a loss. So let's look at a simple example. Pretend that I have as far as my closing entry is going to go, I want to have a debit to income summary for $500 and a credit to expense for $500. And the second one's going to be, I have a debit to revenue for $1,000 and a credit to income summary for $1,000. So what I have to do is that, we know that in journal entries, we always have to have everything balanced. So it will require that I make an entry which will basically, increase my income summary. So we create an imaginary T account on income summary. What I want to have, just based on the one we just talked about, I'm going to have a debit to income summary of $500, and I'm going to have a credit to income summary of $1,000. Well, income summary always has to be 0. So what am I going to do in order to make that zero, or I should say equal. So I'm going to have 1,000 on each side. What I'm going to do is I'm going to debit income summary for $500, right? So I had previously had a debit to income summary for $500. I had a credit to income summary for $1,000. What I'm going to do is I'm going to have to debit income summary for $500, and then I'm going to credit retained earnings for $500. The entry will be a debit income summary, $500, credit retained earnings, $500. If you see that I have a credit to retained earnings, we know that retained earnings is an owner's equity account. Owner's equity accounts, we know that owner's equity accounts increase on the credit side. So if I have a debit to income summary and a credit to retained earnings, well, heck, we know that we had profit. That's how you're going to see. Now, if on the flip side of it, that you had a debit to retained earnings and a credit to income summary, we're never going to have a loss because we know how every one of those accounts kind of flow. That's really all there is to really chapter 4. We're closing the books. We're making those adjustments. So it's not really hard. It's basically we're doing the exact opposite, what we normally do on nominal and temporary accounts. One thing I do want you to do is I want to spend extra time on chapter 2. Chapter 2 is one of your most important chapters because it really creates the outline and it creates journal entries. Nothing in accounting exists unless a journal entry is booked. We may make notes on scratches of paper and everything else, but unless there's an actual journal entry that's booked, it doesn't really hit our financial system. So keep in mind, when we talk about we're going to have a debit, as we book our journal entries, right? Debits always come first. Credits are indented inch and a half, 2 inches underneath the last debit. And the amount for the debit and credit must be the same. The amount of debit, the amount of credit, it must always be equal the same, right? I have a parenthetical explanation, and I want to skip a line. So keep in mind, right? Debit comes first. Credits are indented inch and a half, 2 inches. Parenthetical explanation, and the amount for the journal entry, the debit amount and credit amount, always has to be the same. It has to. There's no way around it. Spend a lot of time on that. I'm real big on problems. I've put my sample problems out there a couple of times. I want you to look at them. That's what they're there for, to help you get that baseline. It's also very important to remember, pay special attention when it talks about how the accounts move. So we know assets increase on the debit side, assets decrease on the credit side, liabilities increase on the credit side, liabilities decrease on the debit side, owner's equity increase on the credit side, owner's equity decrease on the debit side. 99% of the time we're going to credit revenue, 99% of the time we're going to debit our expenses, except for what he's got finished talking about in chapter 4. Learn those, because once you start getting those transactions in place, once you learn that part of it, accounting's easy. It's just rules. It's logic. We think about the transactions, and that's all it really is. So, it's super easy. I want you to spend the time on it, though, and you're going to knock it out of the ballpark, and I know you'll get an A. All right. That's pretty much it for chapter 4. Chapter 5 will be shortly. Bye.